So what would your advice be to kind of be successful and go out and do something entrepreneurial?
Understand how capital works, right? Understand your financial models, but learn everything you can for your job. Be curious about it. And when you get to a point where you can actually put a deal together, start taking swings, right? Just get your reps in and fail. And then see what it's like to raise money in a 30-day clock or a 60-day clock. And if you don't have a deal that you're willing to raise money around, then you don't have a deal. Right? You should be so in love with that deal. You should be so certain that it's going to do well that you should be willing to go take those shots, right? Like just keep taking shots, take swings, keep getting your reps in until you finally make something work. What is the downside? Like,
right.
You learn more in that process. And if you fail, you'll have employable skills.
The Inside Deal is proudly sponsored by the Weiser Center for Real Estate at the University of Michigan, a program focused on developing the next generation of leaders in real estate, infrastructure, and entrepreneurship. Through education, mentorship, and industry engagement, the Weiser Center is helping bridge the gap between the classroom and the real world of deals, investing, and innovation. We're grateful for their partnership and support in bringing these conversations to life. Adam, thanks for joining me on the Inside Deal podcast.
Sam, thanks for having me.
Great to see you. So let's go back to where it began. You are born and raised in the state of Michigan.
Yeah, in Royal Oak, I was born at Beaumont, then raised in Bloomfield Hills. Yeah, went to school in Birmingham at Groves, and then wound up going to Ann Arbor, which is how we connected many years later.
Many years later. Yeah. What were you like as a kid? Like, did you have real estate in your blood, or entrepreneurialism, or kind of what were you like back then?
You know, I don't know what I was like, but I know I spent a lot of time driving houses. My dad is a builder, and so he was building office buildings. He was building single family homes. He was building condos, and so I spent a lot of time with him driving. Every conversation he ever had was in per square feet terminology, and I actually did wind up spending time laboring on his job sites. I remember one particular summer in an office building that he was building, and they had me move all the bricks from one side to the other. And when I got them there, they knew I was the boss's kid, so they made me then move them back.
Cutting your teeth with the real work.
Yeah,
that's great. So was you have two brothers?
Two brothers, yeah, Noah and Cooper.
And were they also working on the job sites growing up? So it was a family affair?
No. I mean, I'm 10 years older than Cooper and 3.5 older than Noah. And I don't think that they were ever doing that as kid, but both of them eventually did wind up in the business. Noah was 21 years with a company called Broder Saxe out of Detroit. One of the largest, if not the largest GCs. He was there 21 years. Started there because my father had hired them to build some condos for him in Royal Oak. And then Noah wound up getting a job with them, starting at the bottom and working his way up. And Cooper eventually wound up working with my dad too.
That's great. Yeah. So you went to Michigan. Were you still working on some real estate stuff during the summers or during the school year, or
that was
or
more
break from real estate for the?
It was more of a hardly working kind of a thing. I was fairly lost in my undergrad years, and it wasn't until post MBA, which I did in DC at GW, where I sort of started to understand that there were things that I needed to learn that I didn't even pick up, in undergrad. I didn't pick up in my MBA.
Right.
And I just started to understand, seeing all my friends, advancing in their careers, that there were things that I needed to pick up on as well.
So you went directly to get your MBA after college?
Yeah.
And then you moved back to Michigan, right?
Yeah. And so from 2004 to 2008, I was working with my father, selling the lofts that he was building in Royal Oak and Ferndale. And then, we got hit right in the nose with the GFC in 2008. And I don't think there was a worse place to be sitting with condo inventory than a suburb of Detroit at that time.
What kind of lessons did you learn looking back now from going through that, especially early in your career, and seeing kind of the mass distress, kind of how you dealt with it, how your dad dealt with it, and kind of how you moved on?
Yeah. I mean, one of the things that I saw early on when we started having these buyers coming in, right? And they would own a mortgage company, and then they'd bring their cousin in, and then they bring their sister, and they just keep flipping the same unit amongst themselves. And at some point, when the euphoria is high, you're making money selling these things, but you're sort of looking at yourself going, it's got to be too good to be true. And it was, right? Because cheap debt, ninja loans, and that was what was propping up the whole thing. And so, you could sort of see it coming and you could sort of feel it out there because the market wasn't deep. The only people that were buying it were people who were doing these, ninja loans to try to then flip it to somebody else that they knew. And so you could kind of feel it coming that there really wasn't a whole lot of depth to that market. And so I think instinctually, we all sort of knew something was wrong. We just didn't know what at the time.
Did you have those actually have those conversations with your dad and kind of say like, something doesn't feel right here?
Yeah. And we were like, well, we should sell more of the units to those other guys, but they'd already bought too many. But in truth, yeah, I mean, we started to talk and he and his partners were looking to sell. Wound up taking the fourth building. They wound up renting them for a while until they could go back to condo sales because the condo market was dead.
So 2008 hit, everything froze. What did you do next?
Nothing related to real estate. I had a friend whose family had moved to Miami and they were opening up an art gallery in the design district there. And they said, hey, you have an MBA, you can't be bad at running a business. Why don't you come down and ride this out? There's nothing you're going to do for another couple of years anyway in Michigan. And so I did. And, for about 2.5 or 3 years, we were in Miami. I was in Miami running an art gallery there. Art may be a worse business than real estate at the bottom. But, as soon as I moved to Brickell, right? And there was no Brickell City Center.
Yep.
Most of the towers that you see weren't there. And it was the coolest thing because I was the sixth person to move into, a 40-story tower that had another 40-story tower right next to it. And I watched the lights go on in Brickell, like floor by floor by floor. The entire icon was dark. Like every single tower there was empty. And so I was renting a 1,600 square foot, 2-story, 2 parking spot unit in this building called Brickell on the River. I was paying $1,600 per month.
Wow.
And Brickell was a ghost town. And you started to then see all the capital coming in from South America, right? Because they didn't want, they were dealing with crazy inflations, or like in Argentina prior to that, like the Corralito, where, their whole currency could just be destroyed overnight. And they didn't care. They just wanted something in the United States. And slowly but surely, Brickell started to become like this financial center for South America. And they started buying the units in like 10s and 20s and 5s. And all they wanted was someone to just pay the overhead. And then the rent started bumping and then all the lights started to go on. And, when the art gallery was sort of done, I had the chance to sort of go back to Michigan. But when I saw how much capital was coming into Florida, I was like, I'm not leaving. I got to find something here.
That's great. So you saw Brickell, you saw what was happening down there. You got the bug to get back into real estate, albeit in South Florida now. Talk to me about your first venture back into real estate.
I was doing supermarket leasing for a Russian grocery store that came to Florida to open up and sort of bring these mini market, not organic, but healthier mini markets to sort of choke off Publix. I think it was the 12th hire there, and we got up to, I think, 300-400 people, maybe more within a year, but the concept never caught on. And so, I was there when the lights were going on. I was there when the lights were going off, but I got to meet every property owner, every broker from, all the way from Homestead, all the way up to Tampa and across, because we were expanding quite rapidly. And, that was a pretty good entry in, but it wasn't investment real estate. It was just something to sort of get my foot in the door. And then from there, I had a series of other jobs for some pretty interesting people. And I remember in my first one, I got to the desk and this guy, pretty storied real estate investor, bought basically all of Midtown out of nothing. He'd walk by my desk and knock on the door and say, "Kid, you make me any money yet today?" And I had no idea what I was doing because I never got the skills to sort of underwrite at that time. I never learned it. And I remember sitting down in that desk and the guy that held the seat before me, he was a Harvard MBA, Harvard undergrad, I think too. And, I opened up his Excel model and I realized I needed to learn modeling. And so that's when I started to really, spend the time after work, before work, going to the internet, trying to figure out like what I didn't know and how to learn it. And that's really where it started for me.
Were you self-taught, or you took any classes online or anything like that?
Yeah, I mean, I took Get REFM, which we use now, obviously, at the Michigan program there. That's Bruce Kirsch's course. I took property metrics, ACRE, whatever I could find online, and that's how I was doing it. And I was, too embarrassed to go to people I knew to tell them that I didn't know. But eventually, I started to understand. And when I got to work for Peter Lewis and Dave Eisenberg at Wharton, that was probably the best job I had in the industry. I was there for 3 years. And I remember, there were some folks there by the name of Dale Casper who taught me how to model. And then, there was a course to do the Get REFM in person. And I said, I'm going. And didn't really ask for permission to do it. I said, I'm going. And I came up to New York, spent the 3 days in a row at the boot camp. And, by the time I was leaving Wharton, and by the time I found my first BTR deal, I could write an institutional memo, I could model, and I understood, how the levers work. And by then I knew enough to be dangerous, but, maybe not enough to slow down.
No, you learn the skills along the way and on the job. I think that's important. I mean, the out of the classroom stuff is just as important as the in classroom stuff.
Yeah.
So let's rewind for a second. So you got a job for Wharton.
Mm-hmm.
What kind of properties were you looking for? What kind of deals were you looking for? What was your role?
So Dave Eisenberg ran the Miami office, and I was in his office there. And my role was acquisitions and development. My role was to find deals, try to package them up, bring them up to the New York office and Peter, and then just try to raise capital around it. And David and Peter did most of the capital raising, but my job was to source.
All different kinds of asset classes, or
asset class agnostic. At the time when I got there, they were doing a mixed use, but mainly residential apartment tower above some retail in Midtown. They'd done a very high-end design district. I think Sub-Zero was the tenant there. And then we bought a piece of land in Bay Harbor Islands, which ultimately is going to be a great project. But we were looking at all sorts of different things. And then Peter, obviously, after that, he started to get into industrial, and it's just done very well.
Yep. So your role was to source deals and do acquisitions. Like what kind of skill sets and kind of how did you do that back then? Because there wasn't a class you could take to say, this is how you source deals, this is how you do acquisitions and how you create relationships. Kind of what was your strategy at that point?
Well, the first thing was to get an understanding of what makes a deal work, right? And that was learning the underwriting and getting to a place where I could really understand why different levers in the model work the way they do and how capital is structured. And once I figured that out, it was more a matter of, networking, right? And the 2 jobs I had before that, I met a lot of people, and I had no problem walking in the door saying, hey, I work for this big firm, and this guy who did X, Y, and Z and is partners with, so-and-so, and using the names of the people who were behind me to push through. I wasn't shy about any of it, and I made good relationships. And, candidly, I always did what I said I was going to do. So if I told someone I couldn't do it, I couldn't do it. I never told someone I could do something and get something done if I couldn't. And I wound up just making some really good relationships. And, what I also found a lot was people valued creativity. And so you could go into a seller that wasn't willing to sell and say, okay, well, what if we recapped you? What if we did something else? How can we get a basis that works for us and liquidity that works for you, for example? And so we tried that, on a number of different deals with brokers. And then also, I remember there was a period where I was really gung-ho on Tampa. There was an arbitrage between Miami and Tampa. Debt was basically the same cost for multifamily value add. But in Miami, they were trading at 475 caps or 5 caps, right? And in Tampa, they were 100 bips wide for no reason.
Yeah.
And so, some of it was just saying, okay, if we're just banging our heads against the wall down here and you're trying to do JVs with people and you can't get anybody, well, where else can we look that has the fundamental?
Yeah.
Right? And so that's, I guess, a window in.
Awesome. I want to back up for a second because you said something super interesting that I think gets overlooked sometimes. You said, in terms of deal structure, if we liked a property, maybe we didn't like the price. We thought of different creative structures. Can we recap someone? Can we, find some kind of creative financing that works for us, works for you? I think that's one of the most important things for deals, especially in times now when you're competing for competitive type property types. Price is discovered. How do you now, and how did you then think about structuring deals from a creative standpoint?
My whole thing at the time was I'm a young acquisitions guy who's going to get bonused by getting a deal done, right? And so my way of doing it was, let's get it done. Like if there's something in the way, let's plow through it. Let's figure out what's going to work for everybody. Let's find some creative way to do it. No, I think is often a failure of imagination. Like there's a way to do something all the time. You may not always get where you're going, but I want to exhaust every different option. And so if a seller tells me that, they're just not interested in selling at a price that makes sense, well, how long have you been in the asset, right? Like, do you want some liquidity now? Well, how old are you? Where are you in your career, right? Because some of these guys are older. They've sat on this stuff for a long time. They're not managing it well. And there might be an opportunity to say, okay, let's take a ride forward. We'll replace your capital, right? But then it's often where am I going to put my own money after that? So,
yeah.
But I think the idea was just leave no stone unturned. Like try everything before you walk away.
So you guys had 2 projects that you were working on down there, development projects, and you found something kind of interesting.
Yeah. It wound up becoming the first build to rent project before build to rent was even a thing. I had no idea what it was, but a family partner of my dad's, his name's Dan Armistead, he owned this piece of land in Bradenton, Florida. And I'd never heard of Bradenton, Florida at all, but I'd spent so much time driving back and forth trying to find those deals in Tampa that eventually I stopped along the way and took a look at it, because he had been under contract with DR Wharton and they entitled it already. It was 184, mostly townhomes, some singles. And he called, he was talking to my dad, I think, and said, DR Wharton's walking from the deal. The soils were, I guess too much lime rock in the soil, and it was going to cost them too much to develop. And I took a look at it for him because there was no exit really in sight from the land. The for sale market wasn't enough. It wasn't high enough at that time to make the prices work for what you had to do with the land. And so, I took a look at it and I ran the math on for sale, and, you'd have to build 184 homes to make like a 13 gross margin. And that's obviously not something someone's going to do. But then all of a sudden, like, I'm banging my head against the wall every day in my job, trying to find deals that work. And I looked at what DR Wharton had entitled, and there were these 1,350 square foot townhomes that were 3 bedrooms with an attached garage. And I looked and said, that's about the size of the 3-bedroom apartments we build. What if you just rented them all? And so I put it in our multifamily development model, and it was almost all 3 bedrooms except for like 12 4-bedrooms. And it was like a 7.5 untrended. And then I started digging in because I was like, did I do something wrong in the model?
Right.
We couldn't build an apartment building, even a garden style, to better than a 6 at the time. And so, we're 150 bips better. And I started digging in, and no, I didn't break anything, but I found out later on that I had the construction costs wrong. I had them as vertical construction, and I had
cheaper,
much cheaper. The thing was like an 8.25, 8.5, something like that. And
what year is this?
17.
Okay.
And the term, like, it didn't exist at the time. And I'm thinking, okay, there's something here. Either I've done it wrong or there's something here. And so I started, there were like 3 questions though, right? How do you lease all those 3s and 4s? And you could see the single family home for rent market was there. They were 97% occupied. They were leasing. The renewals were at like 6% growth year over year, I think, at the time. And so I said, okay, it may take a while to get leased, but there's a market for that. And then the other 2 questions were, how do you finance and how do you exit? And it became pretty clear that you could put permanent multi-debt on it once you were stable.
Was that a recent development in terms of putting, or you could always put permanent multi-debt on on fully rental communities?
I don't know when it came out. It happened for a while, then it stopped. They pulled back. And then it came out during that process where I was reviewing this that you could do it again. And so it didn't matter, right? What your exit didn't matter anymore because you had 400 bips of spread between your build to untrended cap and your debt. I mean, that the cash on that was going to be enough to return capital, I think, in 2 or 3 years. And so, I had the time because my dad's partner at the time, Dan, he gave me, I think, a year to go figure out how to capitalize it. And there was no equity for something like this. I showed it to 1 million people. Nobody wanted to do the deal.
Why do you think there wasn't any equity for that? I mean, because you kind of discovered this, you kind of did the returns, you took care of the financing. There was kind of an answer for everything. Why was there not equity?
It was unproven, right? And I think folks were still concerned, could you actually finance it, even though you could? And then how do you exit? People are still, especially institutional investors,
right,
looking for an exit, looking to see how you can get out, not wanting to go in something that's open-ended and, you don't even know what it is. A lot of people looked at it and said, oh, you'll never lease all those, 3s and 4s. But there were 2 different industries that existed. There was the multi-industry and there was the single-family industry.
Right.
And single-family folks understood that you could do that, but they didn't understand how well you could operate from the multifamily side. The multi guys said, wow, that's great. You can get a lot of, rent premiums for doing something like that and having an attached garage, and you can build it cheaper, but how can you rent that many units? And so there was like a disconnect between the 2 industries for a long time that I think, now it's, that arbitrage is gone.
When you were doing the comp list to see what kind of rents you could do, was there single families that were actually being rented that you could go off of, or were you going off of the 3 or 4 bedroom multifamily?
But both. I mean, there was no 4-bedroom multi, but there were a lot of 3 bedrooms like next door. And so that was such an easy comp because, I mean, literally you throw a rock almost and hit the building next door. There were 2 different multi deals crushing their lease up. I want to say that they were like at the time, 2,400, which was great for the market for a 3 that had no attached garage. We had the same size unit with an attached garage. We built amenities also. I mean, their amenities were nicer, but how does a family live like that, right? And if you look at the 3-bedroom unit counts that were built, I think from 1990 something to present, it's like 5 to 7% 3 bedrooms. Where does a family go, or where does a couple go when they get pregnant, when they get their dog? This is pre-work from home, right? Where do they go if the people in the 3-bedroom units aren't leaving because they can't afford to buy a home, right? And so at a certain point, I started to get really excited about it.
So you put all the pieces together. You got the seller gave you the time to try to figure it out.
Yeah.
You brought it to Wharton. What did they tell you?
They thought it was interesting, right? But I think the idea was at the time, since it's so unproven, I don't think anybody wanted to put their name on it, right? And to take it to institutional capital. It was kind of like, well, if you want to, work on this on your own and you raise the capital, okay. And at that point, I just kind of made the bet on myself, which is like, listen, this, if I can't sell this, I don't know what I can't sell, right? And so I took it on the road and wound up meeting a guy who had an SFR company. Took it to a lot of different people, but he had an SFR company and 3,000 or 4,000 units at the time, eventually 4,000 units of scattered site stuff that he'd bought, off the courthouse steps in the beginning, and then eventually was buying them from home builders. And he said, hey, I've got a great relationship with Lennar. I buy a lot of homes from them, and they're looking to do their first sort of structured transaction where they build a community and then sort of exit it entirely for rent. Let's do this as partners. And by the way, I'd like you to be my CIO in my scattered site business. And so I did that for 2 years. That firm wound up becoming Arc Homes for Rent. And at the time, I started to really see just how efficient BTR was. We had a 33 or 34 person team, I think, at max. And that was to deal with about 3,000, 4,000 units. And you'd be reviewing these data tapes of, 1s and 2s of all these different homes from these builders.
Inefficient.
Yeah. And at best, you were going to buy them for maybe a 575, but in reality, you're going to buy them for 5.25, 5.5 caps that, they're hard to manage. There's so much sort of throughput that has to go through this organization. And in the meanwhile, I've got a BTR development with 184 units that we've hired a builder for, basically in Lennar. We have very little hands-on need to be there because somebody else is handling it. You're going to use an institutional third-party property manager when it delivers, if you haven't sold it by then. And it's just so much easier. And you're building to, north of an 8 at the time, but let's say it's even 6, 7. The math just made sense. And so after COVID, in about 2 years there, and we can go backwards to talk about that first deal in a minute, but that deal had done so well. I had an investor in that deal, and I found 3 or 4 more others through that same family partner. He had one. I had some other friends who had some other things. And I said to him, hey, listen, I got 3 more that they're going to give me a lot of runway on. You want to do them? He said, well, yeah, but if we already have 3 of them, let's go raise a fund this time up front. And so I left, the SFR company, what wound up becoming ARC. And that's when I went out sort of officially on my own.
It's awesome. Let's go back to that first build to rent deal.
Yeah.
So you brought it in. Lennar you brought them in to build the project?
Yeah, it's a structure that's at the time had never been done. And so we all got, bruised up in the process of figuring it out. But, now it's a fairly, I guess, industry-wide standard structure. And so, without giving away too much of it, it's a financing solution as well as a building relationship. And, it allows them to sort of manage, I guess, a future pipeline understanding of what they're going to sell and when. It allows us to build with the efficiency of basically the United States military. They're amazing at what they do. And it's crazy to watch how in control of those sites they are, and how in control of every single brick that goes in and every shingle. They know it cold, and their teams are great. And so it worked out well for both of us. And that deal, though, it was the first such structure of its time. When we went to the capital markets, because that whole structure relies on being able to do a refinance at the time of C of O with vacant units. That product didn't exist on the debt markets at the time, but Lennar wanted to see that they had an out before they got too pregnant on construction. And so we went to the capital markets. And by the way, that line existed for SFR companies, right? They could go buy scattered homes, and they knew that they needed sort of a financing line available to them. And so that product from the debt perspective existed. And it was an easy transition theoretically, because now the collateral, you actually knew what you were getting a year and a half out. You knew that for the next 18 months, exactly what the units would look like. So theoretically, that's a safer, instrument than the one to buy scattered homes where they're all different. And so we started to try to explain to some of these lenders, hey, you should be able to do this. And eventually they sort of got there, and they're like, yes, we can. It makes sense. Like there really isn't anything different about it. But before we needed to actually, sign any docs or get anywhere in the term sheet, we wound up getting an offer from JP Morgan to buy it in advance. So it was the first, to my knowledge, institutional pre-sale in the space too. That, there's some nuance to when you turn over HOA, when you turn over the amenities, when you turn over the streets, when you turn over all these different things that we had to figure out along the way, right? We wanted to make sure they completed the final sale. So you have to think about, can you buy them back if they don't get there? A lot to chew on, but eventually that wound up being a 57.1 net IRR to investors. And we had it sold before, I think before we even had a shovel in the ground, or before we had vertical construction.
It's an easy way to raise more money for a fund.
Yeah.
Than that kind of IRR.
Yeah. And I wish everything was that easy.
I hope you didn't promise them that in the next couple of rounds.
God, no.
So this deal was a success from a timeline perspective. You did this. This was still under the former company that you were working for.
I retained the I guess managing GP position in that, even when I was there. And so when I left to go raise our next fund, that deal was still, I think, in the where was it at the time? I think at the time we had not yet fully signed that JP Morgan deal. And then we signed it shortly after I left. And then, it was just a matter of managing deliveries and turning them over to JP Morgan as they came up.
So at that point, you started Wolfson BTR. And then you had 3 new projects going?
Correct. Well, I had 3 new pieces of land. And so that's a different lesson in and of itself. But there are 3 different pieces of land. There was one in Palmetto, Florida. There was one in Kissimmee, Florida. And then there was one in Daytona Beach. And so those were all sort of dead to rights. I knew the principals or the folks that controlled it. And I was showing them what we did in the first deal. And that's what we wound up doing there.
Were they JVs with the landowner, or you bought it outright?
Yeah. So speaking of before, the Palmetto deal was the same partner, the family partner, Dan. He wound up staying in the first deal as well. And so in this one, he's really been an amazing partner to both me and my family. And, he before we would close on it in the fund that we raised, because the fund wasn't allowed to close on anything that didn't have at least matter of right zoning. Mm-hmm. And this wasn't zoned. And so he was funding the zoning ongoing. I think he even bought the land prior to the fund buying the land, or we had the contract to buy the land. And so for probably a year plus before the fund even got in it, we were doing all of the zoning work on it. And then as soon as we got to the place where, the fund could close, the fund did close. But so that's a JV there. And then the Orlando deal, there was a guy who owned one piece. It's 2 different parcels next door almost next door. And then he was under contract to buy the second one. And so our another partner brought me to my partner there from Paragon. It was First Florida. They're one of the largest multi-GCs in Florida, and good friends and partners. They introduced me to Lewis from Paragon and George, and said, they've got the site. We're going to do multi on it. I think it would work well for BTR. Let's carve it up. And so we did. Our fund wound up being the LP. And then we had small capital accounts for the other partners, but basically a 3-way GP there. It's great. Yeah.
How do you differentiate? Like, what do you really need to find from a entitlement standpoint in just a site plan that works for BTR that might not be the same as just traditional single family housing development?
We've always thought that you need. Well, I think there's a couple things. Different people do BTR in different ways. Some people do sort of cottage apartments, these detached or even attached sort of yard apartments, they call them, that can be studios, 1s and 2s. We look at the product more fundamentally from the perspective of we want the tailwinds and the drivers to be the same as the single family and townhome markets, right? The actual for sale markets. We've built somewhere between 6 and 10 million homes, too few at basically the starter home level over the past God knows how long. And that's a different demand driver than the apartments and the folks who are moving into their studio or their 1 or their 2-bedroom apartment. And so for us, we want to provide them essentially the same home that they would get if it was a starter home, whether that's a townhome or whether that's a single family home, detached. But what we're really looking at are your starter plans. We're not looking at, 2,500 square foot, 4-bedroom homes. The math doesn't work on that. This is supposed to be catered to the same person that would have ordinarily in normal times been a home buyer.
So what are the most important characteristics, like the top 2 or 3 most important characteristics when you're looking at schools? Or
yeah, schools, access to retail. I want to see that these are ideally in places where somebody would also want to build an apartment building. So if you have nearby apartment comps, that really helps out a lot. You don't want to be in what home builders would call drive till you qualify territory, where it's 45 minutes out or an hour out and it's, there's nothing around it. Yeah, you can buy cheap land that way. But who's going to drive that far to rent? Right. Often people will go that far to buy because they can afford to actually own the home out there. But a renter's not going to go that far.
They can get the benefits of eventually that area becoming
correct. But the renter wants it now, and so the schools, the retail, that's really what you're looking for, and access to I don't want to say live, work, play because it's such a cliche, and right. That's really not what it is entirely for us. But it's everything that you'd want for your family, right? That's really it.
So you had your next 3 deals that you did. You raised the fund for them. Did these 3 deals take up the entire fund?
They wound up taking up the entire fund, other than one other deal that we chased and let go, given all sorts of governmental pushback. But we're still in them now, right? And I think that fund closed in 21 or 22, right? And the Daytona project is delivering in Q1, Q2. The first units will come online. It's in land development now. The Orlando deal, the Kissimmee one, is fully delivered. We're about 50% leased up. And the Palmetto deal will deliver in, August at this point, and we're 100% leased on our first deliveries there, which is great. We also wound up raising a second vehicle to do sort of a mini master plan in Fort Myers, and that's another one where we already started delivering about a month ago.
So I think one thing we haven't mentioned yet that I want to go back to. So you were doing this new asset class that probably wasn't even named build to rent at the time. You were involved in multiple different projects. In 2020, COVID hit. Walk me through kind of how you dealt with that. Probably ended up being a positive at the end of the day, but
Yeah.
What your initial thoughts were and kind of how you dealt with that. And
so, I mean, just on a personal level, I remember sitting, and I was still working for the other firm at the time. I remember we're all home from Zoom, and I remember the day that the stock market crashed, and I just thought to myself, it's binary. It's either all going away and it's going to be anarchy in the streets and chaos, or it's going to get fixed at some point. And so I took the little cash that I had at the time saved up, and I just bought every oil stock, everything I could find when the market hit the bottom. And so I kind of thought that I didn't know what was going to happen in our industry. And in order for us to get through this deal, we still had to get through and show Lennar that we had the financing in place. And for a minute, not dissimilar to what's happening now with the Road to Housing Act that hopefully getting solved. But there was a moment where nobody knew what to do, and that was that was a moment where my current partner, stepped up and he said, "Listen, I promised you I'm going to close this thing." I said, "I'm going to do it, and I'm going to do it. I think we're going to be net. It's going to be a net positive for us. And if we need to show the additional equity to Lennar, I'm willing to do it." We were on the 2-yard line of getting that deal linked with him when COVID hit. And 2-3 weeks later, he came back and said, "Yeah, I'll close this. I think it's going to be good for us in the end." And so as we're going through, we had a GMP bid essentially from Lennar where they couldn't pass through overruns. And so as the cost inflation started to hit when the supply chain broke, they took it on the chin on that one much worse than we did. I think we wound up contributing a little bit in the end, but rents grew probably 35-40% as people started to migrate out of, the more restrictive states to Florida. And I mean, cost inflation was probably 30% over time. And the rent it grew even faster. And so it's crazy.
so you made it through COVID.
Mm-hmm.
You have a burgeoning business, build to rent. Everything's going along. You're building a big successful company. March 12th hits this year.
Yeah.
Explain to everyone what happened on March 12th.
On March 12th, let's go backward, January 6th, the president tweets out that corporations can no longer own homes, right? And so everybody's freaked out a little bit, but like, hey, what's going to happen from a tweet? And then there's an executive order that comes out afterwards, and we think we're safe because they say, well, build to rent is additive to supply. There was large scale sentiment, and the public still holds it, that corporations, when we're not going to name them here, when so-and-so goes and competes with John and Sally who are trying to buy a house, people think that that's what's driving up the cost of housing. It's not. And so taking a step back, the rental home market is, I think, 1% to 3% of all homes, period. Institutional owners own 1% to 3% of that, right? So it's so infinitesimally small that it's crazy to think that could move the market. And over 10 years, that small subsect of a small subsect was actually selling more homes than they were buying. And in the 10 years or so that was studied, the price of homes doubled. So it's clearly not the institutions that own almost nothing selling everything that made the price of homes double. It was a supply issue. It is a supply issue. It's an entitlement. It's a zone.
You guys were adding supply.
Right. And so the build-to-rent industry is supposed to be exempt according to the executive order. And to answer your question, on March 12th, the Senate passes their version of the Road to Housing Act, which eliminates the ability for corporations to buy homes one by one, but then says anybody who buys a BTR community that's institutional has to sell it within 7 years. They've got to evict their tenants. They can't sell it to another institution, and they have to sell all of it retail, one by one. They got to put them all on the market. It was just such a mess. We were in the market for 4 different bridge loans at that time, had great term sheets, set for us. And the day that the Senate passed it, everybody pulled out. I think there were 94 active bridge lenders on our broker's list. I think there were 4 by the end of it. So, thankfully, as of yesterday, the Senate passed a revised version of that, which strips out that 7-year poison pill. The House already passed one not too long ago, and they're going to pass one that now coincides with the Senate's. And theoretically, hopefully, we wind up getting this thing signed soon in that period of uncertainty. But it's interesting because it wasn't just this, right? Markets were tough to begin with because post-COVID, like we were talking, you had all this cost inflation. And so what happens, the result of that, which hits everybody's business, not just ours, was the fastest on record interest rate hikes that we've ever seen.
Yep.
Right. And so you go from, cost inflation that's going too high, but rent saved you, to all of a sudden interest blowing the cap rates out on everything. So you can't trade. The market becomes illiquid. Debt becomes expensive. And then as you start to see the end in sight,
you get hit with it.
Yeah, boom.
How did you deal with that? Like, it has to have to be a lot of feelings of, man, this is unfair. Like this is just, coming after me that I'm actually adding supply and helping, people, be able to find homes to be able to rent. Yeah. And now it's destroying my business.
Yeah. Look, as I was saying before, I'm always of the opinion that you can figure anything out. Like anything can get done but this was something that you sort of look at and go, well, I don't know what more I can do. I mean, we're members of the NRHC, the National Home Rental Council. A lot of lobbying went in on behalf of all of our groups from them. We tried looking at recaps. We tried doing all sorts of different things, but the markets were frozen. And so, luckily, again, it comes down to good partners. We were able, through the very same partner that I was mentioning before, John Mulkey, to go out and raise the additional capital that we couldn't get in debt proceeds. And it's been a terribly stressful time, to see all of this happening. But at a certain point, earlier in my career, had this happen on the first deal. And many different things did happen on that first deal, from like a bald eagle that nested in the cell phone tower to all sorts of different things. But, those things kept me awake, and this does keep me awake as well. But at a certain point, when you've done everything that there is to do, you don't take it personally anymore. You look at it as sort of an unknown. There's no way to have predicted anything like this, that the federal government is just going to say, hey, no, you can't do this anymore.
Well, at the end of the day, I think this is obviously bad for single family rental private equity firms because they're basically out of business in terms of buying new things, but it makes it for build to rent community developers like yourself. This makes it so you actually have the one asset that they can continue to grow and buy.
Yeah. And so we do look at it and say, if we, like anything, like what's the saying? Markets can remain irrational longer than you can remain solvent.
Yep.
Right. And I feel like we've been playing with that since COVID. Theoretically, on the other side of it, I mean, the fundamentals of the asset class are amazing. We've built 6 to 10 million homes too few. What's the stat? I think 25 to 40% of Americans are subprime or something crazy like that, can't qualify for a mortgage. People don't have the down payments. They're not growing their families at the same rate as before, but they're still growing their families. They're coming from 2-bedroom apartments. They haven't built enough, like I was saying, 5 to 7% 3 bedrooms. Where did they go? right? And so what build to rent's giving them is basically the same access to a starter home that they would have purchased before. It's the same home. It's the same person. It's a different financial vehicle, right? They need the space and they just need a different way to get to it. And so I've always loved the fundamentals behind it, the secular fundamentals. And then you look cyclically rather, and rates run up. Okay, so there's less supply being built. There's less people that can buy homes. Theoretically, they should be renters if they're not totally scared and, consumer confidence is, not too low. But you've got now cyclically less supply into an already undersupplied market. What should happen? The rents should theoretically go up at some point. On the other side of that trade, the hedges, as rates drop, if they ever do, cap rates get better.
Yeah.
So theoretically, you're sitting hedged on both sides of the rate trade. And at the same time, you have secular fundamentals. And to me right now, you also had this unprecedented sort of once in a generation disruption from this federal legislation thing that happened. And so I think right now, this is when private equity should be buying this stuff. I don't think you'll ever see the pricing where it is now. And that's totally external. It's totally driven by nonsense that happened at the federal level. Not assets.
How much did pricing change between, when this started, before March 12th or maybe before that tweet in January to kind of right now?
It's hard to tell because the market just froze.
Right.
Like who's buying?
Right.
Like I think there was one trade that went off in Orlando, but it was under contract, before that happened and the buyer closed on it. I don't know that maybe 5-10% off of where it was. I really couldn't tell you, but I can tell you overnight the debt market's changed. What was I think we had term sheets at 270 over for bridge, right? And that's for vacant units with some lease up risk to it. I mean, real lease up risk to it. And 80 bips more on spreads, if not more, because of that.
Talk to me about how relationships, you mentioned this partner, I think it's still your current partner, and he worked with your father and same partner, right?
Different partner.
Oh, sorry, different partner.
Yeah.
But talk to me about kind of how relationships just during your career has kind of led you to where you are.
I've had some really, really good partners and I've only had 2 bad ones. And what's the saying? I'd rather have a bad deal with a good partner
with a good deal with a bad partner. I couldn't agree more with that.
It's so true. I've been really, really lucky with my partners, and my current partner, John, who's my partner in my operating business, John Mulkey. He saw it early on. He crushed it with us in the first deal, and just was a believer in the space. And, he scaled companies before he was the CFO of the UFC. He was an early employee there and, did very well for himself. And, he's just been an amazing partner, supporting the business, supporting the opco, always understanding of what we need to do as a company and trying to help grow the business. And then I had my father's partner, Dan, who became my partner in some of the stuff, who owned land and gave me all the time that I needed. I've been really, really fortunate with good partners.
What do you think you did to kind of meet the right partners? How did you carry yourself?
So the story I think that is probably the one that best describes this is, so we were coming out of COVID, right, in that first deal.
Yep.
And my partner, John, I mentioned, he had stuck with us, through all of it and said, yes, I'll keep going there. There was a time in that deal where, as I was mentioning, the debt wasn't available to us, and then the debt was available to us. And so Lennar wanted to see the equity and the debt and how we were going to basically take them out. And so we show them that. And then JP Morgan, as I mentioned, says, hey, we're just going to buy this from you. You don't need to show Lennar anything now. You have a purchase agreement that, you can show them that we're their buyer with the credit of the U.S. Treasury.
Yeah.
And so there were other partners in that deal. And one said to me, well, why do we need the LP anymore? We can just keep all of the profit. There doesn't need to be an LP. We can just, a third, a third, and a third. Dan, me, and you will just split, this thing in thirds as opposed to giving 65% to an LP. And he was right. Obviously, the economics were substantially better and probably 3 or 4 times what we would have made. But in that moment, there was no question. He stuck with us through COVID, right? When the world was at its most uncertain, he said, I'm going to keep going with you guys because that's what I said I was going to do. And I'm going to move forward. And so to go ahead and try to retrade him out of the deal or even retrade the economics one bit in that case was not something I was willing to do. And so as I mentioned, I kept the managing partner piece of that. And, I just said, no, like we're going to honor our word as he honored his. And that is something that I don't even want to say try to do. I think the things that you tell people you need to be willing to stand behind, even if it costs you money.
Could not agree more. So speaking of relationships, Wolfson BTR now you're not the only Wolfson there. You have a couple brothers. Talk to me about kind of how that came to be and what it's like working with close family.
So originally it was me in my third bedroom in my house running this, and we brought on our controller to work sort of part-time, and it was me, John, and our other controller, John. And then at some point we needed some help on the underwriting, so I brought somebody on for that, one of my first hires, Daryl. And it got to the point where we now needed project management. We needed someone to oversee construction. And my brother Noah had been working for 21 years for probably the largest GC in the state of Michigan and regionally there. He was overseeing these really complex projects. They would call them hazard pay, but he was off on islands trying to get the locals to build stuff, which maybe is hazardous, but to me it seemed interesting. So he was living in San Juan, building the Mall of San Juan. And then he was also living in Waikiki, building the mall there. And then the hurricane hit San Juan. And so he's back and forth, racking up miles. And I'm saying to him at a certain point, listen, I'm going to need to hire somebody soon. I'll give you equity. The projects I'm doing are so much less complex than building and overseeing these large malls and in these islands. And he didn't really believe that I had a business, I think, at the time, because I'm just his older crazy brother,
right,
or crazy older brother, depending on how you think of it. And at some point, he came to Florida, and I took him to the office. And I think we had an office at that time. I think we had just moved in. I showed him that there was an actual physical location, and started running through the projects. And he said, "Oh, you really built a business." And I said, "Yeah." And I did. I now need someone, that I can trust, because that's really more than anything what it is. I don't have time to be on every single phone call. I'm sure you don't either, right?
Yeah.
I don't have time to do every single thing that's necessary. And you need someone who knows what they're doing, number one, but number two, who you just know fundamentally is not going to do anything wrong, right? They're just, I think you just need to surround yourself with really, really good human beings more than anything.
Yep.
Because you can find talent, you can find people that can do the job, but you can't always find people that can do the job and who are just fundamentally good people. And so at a certain point, I said, just tell me what it takes to get you here. And he came. And a few years after that, maybe a year and a half, 2 years after that, my youngest brother, who had been working in project management, was available. And to me, why not bring them on if you have something that you can share in, right? And I think that's I think it's sort of incumbent upon you, if you've been able to build something, to try to get your family involved in it.
That's special. There really is. What I like to call it a 90-mile-an-hour fastball. What has been your skill that you've had that you think you do as well or better than most that's really been responsible for your success?
Persistence, like I was saying before. Like, to me, if you say you can't, it's really just a failure of imagination, at least for the moment.
Yeah.
When my kids say I can't do something, it's I can't yet. Like that's the redirect. When we started, there was no BTR. You didn't have anything to tell you that there was anything similar. I mean, there were some guys doing it in the West Coast, and they'll kill me if I don't mention them. They were in Texas and Arizona. But on the East Coast, we've never seen it. And I certainly didn't know of them when I started. But there was no debt product available. There was no, like, how do you get construction fit? Like, you had to sort of push your way through everything from the start. And then there was a saying that we had a bald eagle that apparently nested on the cell phone tower. And then we couldn't get the easements I had to go to LinkedIn to find the chief legal officer from the cell phone tower company up in Boston to then get them involved because we couldn't get it done. Lennar was going to walk from the project. Like, you have to just find a way. And I think more than anything, that's probably what it was. And when I didn't know how to model, I was sitting at my desk at 11 o'clock at night while my friends were calling me getting drinks. And like, no, like, this is, we're going to figure this out one way or the other. And, you know, I've said this before, but like, this was the age of the internet. And if you want to do something and you don't do it, you really didn't want to do it.
Yeah.
Right. Like, the knowledge is there. Like, you should be able to figure it out.
Even more so now with AI. I say to people all the time, it's like, there's no excuse to not be very knowledgeable about anything that you care to be knowledgeable about.
100%. And, you know, there just has, I'd say curiosity is a big part of it too. Curiosity. And then like the persistence to just do whatever it takes.
Curiosity and persistence combo is a winning combo.
If the federal government doesn't get involved.
Well, you'll find a way.
Yeah, for sure.
So what would your advice be to kind of close things out here to either students or people early in their career, or someone that wants to build something new, to kind of what your advice would be to kind of be successful and go out and do something entrepreneurial?
Do it. I mean, there's so many different pieces of advice, but if you think about it, if you're in an acquisition and development role and you don't succeed in your job, you're going to lose that job. Yeah. Right? So what's the downside really? You're already at effectively the downside. The upside is, if you really truly understand how to raise capital around things, and that's probably the biggest piece of advice, understand how capital works, right? Understand your financial models. Don't leave school before you've learned that stuff. You know, we in the program that we're in, yeah. I think that's the biggest piece of it. But learn everything you can for your job. Be curious about it. And when you get to a point where you can actually put a deal together, start taking swings, right? Just get your reps in and yep. fail. Yep. And okay, so get your deposit back. Yep. You know, do something. And then see what it's like to raise money in a 30-day clock or a 60-day clock. And if you don't have a deal that you're willing to raise money around, then you don't have a deal. Yep. Right? You should be so in love with that deal. You should be so certain that it's going to do well that you should be willing to go take those shots, right? Like, just keep taking shots, take swings, keep getting your reps in until you finally make something work. And what's the downside? You go get another job?
I call it an asymmetric bet. I think one of the most important things that determines success from failure in life, or doing what you want to do and not doing what you want to do, is limiting your downside and having all the upside.
100%.
So just keep on taking shots. 100%. Keep on taking shots, and eventually one will work.
Yeah. And again, what is the downside? Like,
right.
You learn more in that process. And if you fail, you'll have employable skills.
Couldn't agree more. Thanks so much for being here. This has been, Adam, this has been a real pleasure. And your story is really awesome to see, and look forward to seeing what you're doing going forward.
Sam, thanks very much for having me.